Hello and welcome to ONFIF's second session on asset risk management. We had a very enlightening, engaging session this morning, which was excellently stewarded and moderated by my colleague Neil Williams, who is the chief economist within the Economic and Monetary Policy Institute here at ONFIF. I am Ellie Groves. I'm the managing director of the Economic and Monetary Policy Institute, and I'm very pleased to have this second session where we will be focusing on the managing risk longevity of post-pandemic trends, but also with a real focus, and we're very pleased to have the Deputy Governor of Norges Bank, who will be giving more detail on this, on the ESG climate crisis portfolio management and how the climate crisis is figuring into the asset and reserve management, especially within the context of risk. So I'm very pleased to welcome Lauren Rosber-Watt, who's Investment Manager, Research and Strategy Group at CalPERS, the California Public Employees Retirement System Pension Fund. We also have Didier Borowski, Head of Global Views Amundi. I want to also thank Amundi for the support in the wider asset and risk management seminar series. We've been doing these a good few years now and are very pleased to have Amundi's ongoing support throughout them. Then we will close with the opening remarks from Deputy Governor Øystein Borsum, Deputy Governor of Norges Bank, who has also his responsibility lies also within the Government Pension Fund Global. And I'm very pleased that we will start with Lauren, who will give a broad out view on the managing risk and also the pandemic regime shift questions. Lauren, it is 4 a.m. where you are, so we just have Lauren's voice to regale us of these very important points. So thank you so much all. I thank you all for listening. Just to clarify, please do put your questions in the Q&A function that you see on the Zoom, and also this is being recorded. It's entirely on the record, as was this morning. So Lauren, please, over to you.
Thank you. Good morning. Listen, thank you for the opportunity to speak today. You know, it's a really interesting topic, and I'm going to come at this from more of a macro perspective and finish off on ESG in order to pass off when we talk about climate and think around climate in our portfolios. You know, it's really easy as an economist to start getting, pulled into the details of the current thematics and what's happening in the world and what does that mean and the nuances of, macroeconomic variables. But I want to spend some time today taking a step back, a much higher level. We're caretakers of our members' funds, and steering the ship means, making small shifts, I guess, within the horizon that we have to keep in mind, that very long run horizons. So when I think around these long run horizons, long run trends, there's a number of trends that I can think of that I want to talk to you today. Now, some of these are well known, so I won't go through them in great detail. Other of them I feel that we have a good handle on, and some, just they're open questions. It's either too early to tell to get any good sense of the direction or the impact, or they just haven't been, explored in the literature. Now, these all matter, of course, because of the implications on returns, for risk, for the distribution of expected returns, or for the relationships between different asset classes. And I say this because, of course, that helps us to inform our decisions. I think maybe it's worth taking to point out here, I guess, that although, this is I'm part of the economics, markets and economics team, we're not in the business of forecasting per se. So, of course, if I get the correct, we do forecasting, and if we get the correct point estimate, then that's fantastic, and I'll take that anytime we can get it. But more generally, our role is around asking questions, testing the portfolio. Do we understand the trade-offs that we're making when we're making these investment decisions? So let me give you an example, one that's broadly well known, so you understand sort of where I'm coming from, and that is this demographic shift and the decline in population growth many Western economies are experiencing, and that has some implications for real economic activity, for profitability and earnings for firms, for things such as the real neutral rate, also potentially has implications for inflation, and the theory says one thing, but the empirical literature seems somewhat mixed on this point. So when you think about your nominal returns versus your hurdle rate, your real returns, that can have some changes in terms of the drivers for the assets and the liability side of the pension fund. I'm not going to go in to talk around what's happening right now with respect to the Russian-Ukraine conflict and what that means on the largest perspective, but it fits within some of these topics. Once again, if I take this step back with respect to the pandemic and the global financial crisis. So the speed and the decline and then the recovery of the pandemic was exceptional. But recall, we also thought the decline was exceptional with the GFC, and this has direct implications for risk. And when I talk around risk, of course, I'm talking around the range of outcomes around an expected return. So, over the past 40 years, recessions have typically been the result of a period of extended growth and an overextension of credit, whereas the most recent recession was a result of an external shock, culminating in a drop in supply as well as a drop in demand. All right, so things seem quote unquote unusual. And does that mean the expected distribution of potential future returns is also wider? I guess I place the question in the context of, is the last 15 years exceptional or unusual? Or is it relative to history, or is it that the period post-GFC up until the early 2000s was somewhat exceptional or unusual? And when you put it into that context, you can think around how you need to focus on your portfolio in slightly different ways. Let's zoom in. Another way to ask the same question, I guess, is whether the global economy has experienced a regime shift. And regime shifts typically are associated with changes in not just returns, but in particular I'm focusing regime shifts with respect to volatility of those returns. It coincides with changes in monetary and fiscal policy. If you look over history, also coincides with in earlier days regulatory policy. The question I have then is, has the pandemic, extended the policy thematics that were already in place in the GFC, such as quantitative easing? Is the world really a different place? Or is it just that this is one standalone event? And again, I'm going to ask these as open questions. We have views internally, but just around some ways in which we think around what's happening in the world. What are some of the other things I could think of that inform our thoughts around risk and return? Some of the questions, I'm sure that you all know of or have spoken to are things such as, in the event of another downturn, how much scope is there to ease economic and financial conditions further? I prefer to ask the question around whether future policy responses will continue to create an asymmetry of future expected returns that we've seen. Relatedly, are the asymmetry of returns for particular asset classes, given the type of policy with support we've seen in the GFC and in the pandemic-induced recession? And then, what does that mean for correlations and covariance of returns between different asset classes? Does one asset class have greater support by central bank authorities or fiscal authorities than another? So how do we manage these risks? We're a long-term investor. I mentioned that before. We can certainly tolerate some volatility in asset values, but as long as sufficient liquidity is available, and that's quite key for us as a defined benefit pension fund. This long-term horizon gives us an advantage. You can see I'm asking these very, very large questions, although of course we do need to have day-to-day practical implications for the portfolio. But it does mean that we aim to diversify our portfolio across a distinct number of risk factors. And given the long-term horizon, of course, one of those, a large proportion of the risk factor or the factors that we have is attuned to growth. And the last one, when I talk around these sensitivity testing and scenario testing around these trade-offs, is we only want to take risk where we have a strong belief that we're going to be rewarded for it. And that comes down mainly to our governance portfolio and the way in which we apply the governance to our portfolio. So the last one I want to speak to, of course, is this leading into ESG and the climate side. And it links with this growing consensus around ESG-led investments. Much of what we do and economists in general do is around building models and relationships that predominantly are based on GDP. But we also know that GDP, or real economic activity, is not fit for purpose. So if we focus on societal benefits and positive externalities of ESG, this ESG-lensed approach is one way to shift away from growth for growth's sake, GDP for GDP's sake. Now, of course, our fiduciary duty is to meet our return targets, but also to minimize the risk. And to the extent that ESG-lensed approach to investing is certainly doing both of those, hitting both the return and the risk side of the equation. To me, that's what I call stewardship, and that's what I think we're in this industry for. I'll pass back to you. Thank you very much for the opening remarks.
Thank you very much, Lauren. I think it would be good to pick up on some of the questions around the 4 channels for your overarching process and framework for within the ESG space. But perhaps we can hear from Didier first, the Deputy Governor, and then come back to you on that and any other further questions the audience might have. But thank you, Lauren. That was a very comprehensive overview on both the beginning with how you are looking at the current macro environment, how you view risk within that, and then also how you are as a pension fund looking at your frameworks to meet that risk within especially ESG. So Didier, over to you, who I think will follow a similar framework, but from more of a markets perspective and from a European focus. So it's very, very pleased to welcome you here. Thank you, Didier.
Thank you. So just, yes, to come back on some of the issues that have been raised, what we saw since the start of the year is a significant shock on most markets that were driven by recently, as you all know, the war in Ukraine. But it's a big, in fact, before the war, and that's an important point after the COVID crisis, what we see is that the fear of rising inflation and the interest rates and the fear of higher interest rates coming from the United States were already there and had already triggered, I would say, some rotation in equity markets in the start of the year. We face very challenging times, in fact. First of all, to finance the energy transition, as you all know, billions of dollars will be required in the coming decade to finance this energy transition in Europe and elsewhere. And in addition to that, we are living in a period of higher political uncertainty recently that will probably reshape also the strategic needs in Europe. My point is that on the top of what is required to finance the energy transition, we now all understand that defense spending are going also to be of the utmost importance for most European governments. What does it mean in practice? It means that we will probably live in a world in the coming decade with stagflationary pressure. We already experienced stagflationary pressure as a result of the Ukrainian crisis, because GDP growth is going to slow markedly probably this year. Inflation is going to jump. But my point is that it goes far beyond, in fact, what we see in Ukraine. We expect, in fact, also the energy transition at some point to be somewhat inflationary and to weigh on GDP growth in the coming years. So the stagflationary environment is here to stay. And we'll put a lot of pressure on central banks, starting with the ECB, because it's probably in Europe and in the Eurozone that we will see first the stagflationary pressure. And in this environment, we can expect, in fact, the central bank and in particular the ECB to remain quite accommodative in the short run. And everything is possible in war times. And looking ahead, we would expect the ECB and governments to think about, how to cope with strategic needs in Europe when it comes to financing the energy transition and to financing defense spending. There will be an exceptional, European summit this week. And that will be very interesting to hear from our governments what they intend to do and how they intend to finance the expenditures that are required. But my point here is that the Ukrainian crisis is probably a game changer regarding the way we are going to look at our expenditures looking ahead. We don't have the means in many countries to implement, I would say, in an orderly manner, the energy transition and to increase at the same time defense spending.
Didier,
that means that at some point, yes.
Sorry, if I may, I want you to
Yes.
continue this thought, but I want
Yes.
to slightly throw a question at you where I think you might be getting to, but also, do you think that so far monetary policy and fiscal spend for the COVID response have been working together, at least towards the same objective, and have been very open? But as you see the ECB talking around, the ending the PEP program, but as you mentioned, there's going to be even more of a need of fiscal spend because of the Ukraine crisis. Do you see the disconnect between the two, or do you think that central banks will have to put pause on their normalization processes?
No, it's quite unlikely to see a normalization in the short run. We live in an exceptional period during which we will see an economic slowdown, and the ECB cannot deal with inflationary pressure when these pressure come from a pure supply side shock. So my point, in the short run, so for sure the ECB will want to maintain all options on the table, but we expect a dovish bias in the short run regarding the shock that we'll see on economic activity in the short run. But what we expect for sure is that at some point in the coming months, real interest rates should re-increase. Real interest rates will stay in negative territory this year and probably for a long time. But at some point, we believe that it would be a mistake to see that core government bonds are a true safe haven. In this environment, we stick to the view that it's a paradigm shift even for investors who will need to focus more on the equity space and on some kind of proxies in the equity space or in real assets of what could be perceived as safe havens looking ahead. In this environment, stagflationary environment, government bonds are no longer a safe haven. That's a key, a very important point, I would say, in terms of asset allocation. So it would be a trap to consider, in fact, that you are protected with by increasing your exposure to governments in this very particular environment. It would be also a trap to believe that in this stagflationary environment, you should get rid of your equity exposure. Quite the contrary, I think we will need to, in fact, increase the granularity of our expertise on what kind of equities can generate returns on a regular basis. And you have also all these ESG thematic that will stay. I would say that will remain a very important thematic. So at the same time, probably our governments and the ECB will try to consider the strategic needs of Europe. And my point is that this big crisis might be, at the end of the day, an opportunity for our governments to consider this paradigm shift in terms of fiscal policy and what it means in particular when it comes to monetary policy. Should we have to consider special bonds in order to finance these strategic needs that could be purchased by the ECB? I think it will be, in the coming years, an open question. And given the fact that there is a paradigm shift and that it's now well recognized by most policymakers in Europe, we may consider some options at the European level that were not on the table previously. And that's something that is very important, I would say, to consider for investors. So for sure, now you have a kind of a war risk premium on European assets. But my point is that if our governments make this recognize this paradigm shift, European assets, some kind of European assets, and could become attractive again.
Thank you very much. I think what I want to come to now is the Deputy Governor, who has a short slideshow and then also some answers around how Norges Bank is looking at the climate risk and placing that into your portfolio management. So over to you, Deputy Governor.
Well, thank you very much, Henny, and good afternoon for inviting me. I'm very pleased to be here in this panel. I would start out. So my topic's going to be on climate change, climate risk, but I thought I'd give you just a few words on our. So Norges Bank is also the Central Bank of Norway, and it's also the manager of the Norwegian sovereign wealth. And this is one of the world's largest sovereign wealth funds. If you slide, you will see a few key facts. 70% of the fund invested in equities. This is equities, and these holdings are spread out across thousands of companies. And in many ways, we have followed the textbook approach of owning it. But even so, with investments spread out, the fund is so large that our average ownership share in these companies is 10%. And this means that quite often our fund is one of the top in these companies. The investment strategy is decided by our Ministry of Finance, but it is also anchored in to have across the political buy-in. This is really important for strategy and also for our ESG part of our strategy, or responsibility to call it. And within that framework, Norges Bank Investment Management, a separate unit within Norges Bank, is the operational manager. And I, as a deputy governor, I am a board member. So for our fund, long investment horizon, clearly climate change is an issue that we believe very profoundly. We have a financial interest in companies adapting well to and opportunities that are presented by climate change. I mean, I think it's one of the defining and paramount of our global economy in the 21st century. And I hear some people that's going on in Ukraine and the security situation. This will be the return of cold and everything else, but I don't think that's going to be I think it will be boosting the advanced cleaner energy in hand with the issues of in Europe. So from an investment perspective or for climate risk, so the big discussion out there is versus engagement, and we have made a very clear choice: engagement, the engagement part of that continuum. So our active ownership to be a driver for change, pushing companies towards lowering changes in business models where that is needed. And of course, we need to be owners, and recall with 1.4 average ownership share, we are quite often one of the top 10 shareholders. And for us, with that type of fund, to aim for that we invest in, they should listen to us. They should listen to all surely larger shareholders will have a voice. So next page on the slide here. I'm new of the keywords that we attach to our risk. We can think about it as three broad areas: what we do in our portfolio and how we work, we invest in. So for the next, you can flip to the next, emphasizing that I will not be discussing these items. So if you flip to the next page, you will see the ones that here in this. So a very short introduction, concentrate on emphasize why we think this makes sense. I will emphasize also how we think they fit together and what we call it at each. The points are not to be seen, but also in how they work and strengthen each other. We think that we have an important role to play in development of reporting and measuring companies' climate risks. I'm thinking and other standards, and obviously more information climate risk in companies, and therefore make better financial us. It is for every participant in the markets, and I think us, because we are very close to our investment, better pricing of climate risk means a more efficient benchmark, and that is in our clear interest. The next point so reporting is good, but we also want to know how companies are actually handling, and we have communicated a set of clear written down expectations with other topics in responsible investing. We expect companies to have climate targets, report on progress, stress test their business models, and all companies. So we have more than 9,000 companies, and you know, we cannot dialogue with, it's just not feasible. But we can collect data, measure, and benchmark for almost all of these companies, and we can use that in investment decisions. And one of the uses for is that we can use that information to prune out high-risk company, and that's the point that you see there in the middle and the lower name there, divestment. So I said I've taken a clear stance towards engagement, but that doesn't mean we don't do divestment. So we'll prune out high-risk companies from our portfolios, we call. And so these are companies that we believe are managing climate risk, and again, it links to our expectations. To put it simply, if you want to stay in our portfolio, you should comply with our expectations in this area. Otherwise, we would take it as a relative to have a climate strategy if you don't have stress test your portfolio, etc., etc. So the focus, sort of our main approach is on companies. So this is to be a driver for change. And last year, our organized 3,000 company meetings. And sustainability here is included on the agenda. And these company dialogues, again, so we follow up on those points and emphasize and go in detail what companies are actually doing in the field climate risk. So, and generally we take a constructive approach, right? With rather than against the companies, we want to work with them over time, make the necessary changes in the business model. Of course, dialogue is good, but the dialogue will not always halt. So even if we emphasize that, we know that we have a few more to employ to make companies listen. So it's through our voting. We increasingly hold investment companies to account for their decisions through our voting. So clear, that means voting against reappointment of directors, for instance. This is when we think they have not done their duty in the way that they should. And we do a number of started publishing our voting intention 5 days in advance. That tends to attract internationally. And the point here, of course, is again and strengthen that dialogue. The tool, which is pointed out, is called exclusion. So in exclusion, we use these two words because we have different occasions for them. The divestments are done uniquely on financial conditions. So the point is to reduce. The exclusion part is made on ethical grounds and ethical guidelines that are set out by the Ministry of Finance. And these are a number of issues, but also cover issues related or linked and unacceptable greenhouse gas. So that concludes these decisions. Again, to strengthen them, they are made public with documentation. and they also attract quite some attention in the international community. So again, to a message of this chain of tools, and I think there's much more to say here. We'll leave it there and with the discussion.
Thank you very much. My first question is actually around if you have a company which you have invested in to engage to transition from brown to green, and they aren't playing ball, they aren't disclosing correctly, or how do you manage them off your books, or what are the steps that you might take to exclude when they do not meet your expectations, but perhaps kind of that step further, I guess, the supervision? How do you supervise, not just have that initial disclosure mechanism?
Good question, because for the past few years, I think the reporting, the main parts of our regarding climate change have been exactly that. We need more information reporting. And on this, on this issue, have made tremendous progress. We don't know exactly if it's also clearly not. So there's a lot of pressure from different, but there has been tremendous progress on reporting. Now, what needs to be done from reports into actual. So I think we are just at that point where we exactly what will be the conditions here, because we know that energy transition and waning companies and fossil fuels is going to take time. So we need to use some leeway to make some time to be able to make, but we cannot allow infinite time, right? So I think our build around the consistency, so the consistency for between a stated goal of reducing emissions, investment projects, are they, do they realistic projected carbon emission as a carbon reduction, or is it not? We have not, so we have excluded some, on ethical grounds. They're mostly related to coal, so in oil sands. These, in our opinion, been justified, very hard to see them in a future low carbon world. I think your question is exactly right. We need to come up with design criteria that will be objective and often that we can use to say that, well, this is not good enough.
Thank you. I also want to ask actually both Lauren and yourself, and Didier as well, your thoughts, and then I'll go to, I've had a few questions come in from the audience, which is fantastic. I'll go to David first, but first of all, I want to ask, and perhaps Lauren first. So we've just heard from the Deputy Governor, which on a very clear exclusionary, but also divestment platform on how to engage with ESG and disclosures and reporting, how important that is. My question is should that be held with, so I guess the taxonomy question and the reporting and disclosure question, should it be held by companies themselves, by central banks and by investors, or should there be a independent body that is all agreed to with these requirements and that monitors for the institutions, the institutional investors? So Lauren, please go to you first to keep you awake at what is now 4:30 a.m. for you. Do you think that these, when we're talking on green investments and ESG investments, it should be held for each investor themselves to work out what their criteria is, or should there be an agreed international body that supervises this?
Yeah, thank you. Listen, I have a coffee, so I'm feeling great. You know, ask me in 2 hours, and I might be late for work. Who knows? You know, listen. When I think around this, I would say at this point, you know, this is burgeoning, this is new, and you know, to the points made, it is. We are not yet at the point where there is an established sort of form of data collection and reporting, and certainly moving in that direction with things like the TCFD. That said, though, I think any movement in that direction at this point is positive movement, and I would imagine, you know, at some future state, that in future iterations, that there is some form of agreement around, you know, which we already have to some extent, around what we should include and not, and how we report it. And there are certainly, you know, private firms looking at present around trying to formalize or standardize a process. But I think trying to constrain it and require it in one particular way versus another at this early, relatively speaking, early stage, you know, I think could potentially be, you know, slowing down innovation that we really don't know might end up as one of our, you know, potential positive endpoints. So I think anything that we can take at this point is positive movement in the right direction, and we should be, you know, encouraging that across all firms and pension funds and asset managers.
Thank you. Didier, the same question to you. When you look at this question of ESG, do you feel it should be a holistic approach done by one institution, or for reporting and standardization purposes?
Probably, yes. There are different dimensions to answer to this question. My point is that if at some point you expect central banks to help the financing transition, my point is that you probably need a body that is independent from governments, in order to avoid, you know, some greenization that would be, you know, a political debate in certain countries, etc. So my point is that if you really believe that private savings are not enough to finance in the coming decade the energy transition, probably an independent body which could guarantee the fact that certain investment projects are in reality, in fact, really green. That could be quite important. Another point that I'd like to answer is that when it comes to what is ESG, etc., my point is that the green taxonomy, for instance, in the EU, is also a matter of strategic autonomy, and that's also something that is important to consider looking ahead. If Europe wants to attract, you know, several billion of euros, you know, in terms of investment, it has to have its own criteria to define what is compliant with ESG, and it will probably strengthen, in fact, European to adopt, you know, that kind of autonomy, you know, to have a kind of autonomy in standards. So that's something that is very important. It's a kind of weapon looking ahead in order to finance, I would say, to attract new investment coming from new foreign investments. So that's a strategy, also something which is highly strategic, I would say, to have our own standards and to be able to impose our own standards within Europe. There is a battle on standards, and Europe needs to be very present on that point.
Thank you. We have a second question for Didier, and then I'll come to the Deputy Governor for that same question. But Didier, follow up from that, because it links to what you were just saying. What kinds of short and long-term investment strategies are needed to boost the energy transition, do you think? How the public and private sector, do you think there is enough in private funding, or how should the public sector be looking at this? You touched on it in your opening remarks as well around the ECB.
In fact, yes, there is massive savings in Europe. So my point is that we need to find a way to channel private savings toward, you know, ESG investment. We expect massive demand for ESG products looking ahead, in line with what we've been talking about, you know, about the need. But we do believe that it will probably not be enough. At some point, we need to find some public-private partnership, or private investors will need to be reassured and to see that our governments also do their part of the job. So you need to mix private savings and public savings. And that's why, and that's another topic, I talked about that earlier, but fiscal rules and the way we consider public expenditures will be also crucial. But for sure, I would say the capital market union, for instance, is essential looking ahead to mobilize private savings in order to finance this energy transition. And we believe that it's something that is achievable. It's also more true that the crisis that we've been through, either the COVID crisis or now this war in Ukraine, are probably a call for unity in Europe. The only way to deal with external constraints, and whatever they are, I mean, either geopolitical, shocks or shocks coming, on health. At the end of the day, it's a call for unity in Europe. And my point is that we may, that Europe does only make progress in crisis time, and I think we should take the opportunity of this enormous challenge that we face in order to find new ways at a global level in Europe, I would say, to deal with these challenges collectively. And my point is that the next step is probably to go much more in the direction of a banking union and of a true, capital market union that will for sure help to finance the energy transition.
A common topic here at UNFIF as well is how to develop a capital markets union and banking union. So I think that it is very much integrated with the financing need in Europe. But Deputy Governor, to you, I want to put the question is that you set out a very clear framework for exclusion, but also inclusion into your ESG portfolio for the 9,000 companies that you manage. So I just want to ask, do you feel that that is enough, that it comes from you, or should there be an international supervision? There's obviously the European Green Taxonomy that supports this, but the reporting and standardization, should it come from an independent body to monitor the disclosure from private companies?
Well, so I think in terms of the reporting and the TCFD framework is quite appropriate, and that there will be standards are being built as we speak, such as biodiversity and environment more in general. When we relate that, so I think standards is a way forward. Be established if we need a third party that will clearly, own that standard. I think that in many ways is well in the market as we see TCFD and other standards evolve. On is there enough capital for the energy? I feel that we stand ready but right now, at least up until the pandemic, I think that there wasn't enough private capital that was willing to go and say finance, or rather to the contrary. I think we see that the problem is more that there isn't enough projects. Extent that profitability in many of the recent projects that have been out there has been very, very low. So green financing now from the private sector, at least in the developed market, is abundant, and what the public sector needs to do is to make sure there is enough projects to be built out there. The energy sector infrastructure is there, so that our project, another wind farm, is actually feasible. I'm thinking about, but also the capacity constraints in that. I think these issues are likely to be solved. At least the European governments will now do in the current situation, is that these investments and these available projects are being beefed up quite heavily. At least that's my expectation.
That's very Good, and heartening to hear, hopefully, that there will be more products that can accommodate the desire for green investments. We have a question here from Patrick Flynn before I turn to David. So David, please do be prepared, because I will come to you in a second. David Marsh, Chairman of UNFIF, will be putting a question directly to the panelists in a moment. But Patrick asks you, Oystein, in your company selections, are you allocating to any enterprises that are targeting the UN SDGs, Sustainable Development Goals / impact investing? So a little bit of a question on deliberate investments as well, and how you view that. And then Lauren, if you can come into that as well, but Oystein's to begin with.
Yeah, okay, so no, not really, but we do have a full mandate at around 100 billion Norwegian krone, in essence financed by investors. So we defund parts of companies that would pay browner and channel it towards companies that would be. So in that sense, the answer is yes, but in the way you phrased it, no, they are not specifically SDGs. They're not done with an approach of impact investment. Our approach that the purpose of the fund is financial, aiming for financial returns in a responsible way. And to that is that the way that we have phrased our so-called expectation climate change, we've written down expectations. We've done that on all the important parts of questions on and social. And when you read them, you will see that the SDG present, they are very much in line with what is the Sustainable Development Goals. So in that sense, and we do out to all the companies, all the 9,000 that we have in our portfolio. So trying to make, say, ESG into a separate portfolio, to make ESG or responsible investment part of the entire.
Thank you. Yes, I think that goes back to actually a question that David wants to ask. So Lauren, if I can store up that question to you as well around the focus in impact investing. But David, do you want to come in and ask that one? Because I think it links to the holistic approach as well.
Yes, thanks very much. It ties in very well with what Oystein has just said. And very good to see you, Oystein. We had your old governor, the other Oystein Olsen, with us on our advisory council just yesterday, actually, saying some very interesting things about Norway's role in this energy transition. But the question I've got, which is really for you, Lauren, and ties in very much to this question of whether there should be the separation of ESG. As you may know, I've been talking lately to your old head of sustainability, Anne Simpson, who's now joined another company. And she has the view that one should make ESG no longer selective in the way that Oystein Bossum has just been saying, applied to different portfolios, but should make it much more holistic. So it applies to everything. I'm sure you've heard this before, Lauren, but it'd be very interesting to have your view on whether it should be broadened out, because Anne Simpson believes a siloized approach could lead just to box ticking and could lead to potential misuse. And then the other question linked to that, which I've got particularly for Didier, is on the familiar question of nuclear energy, civil use of nuclear energy. After all, in the German coalition agreement, it also says strategic sovereignty. That's a goal of the German government. So do you think, Didier, now, given the events in Ukraine, given the disquiet about Germany's undue dependence on sources of energy from Russia, that Germany should now unite with France in greeting the fact that nuclear energy should be deemed a sustainable energy source in future? How would you look at that from an investment point of view? So those are my two questions, which are in a way rather linked together. So thank you very much. I think Lauren was the first recipient of this question, wasn't she?
Yes, David, thank you Lovely to chat to you again. Listen, very wide-ranging question, and Anne Simpson is excellent and a huge loss for CalPERS, I have to say. I would couch my response in one that if you consistently consider your return targets and your risk, making sure that we manage the risks or understand the risks to the extent that you can, of course, then an ESG type framework automatically sits within that framework, to Anne's point. That said, CalPERS wouldn't be where it is today without having a separate focus on sustainable investing. You think of, CalPERS started some of the partnerships that we've had. We've started this Climate Action 100. There's what is there now, over 600 odd investors. We've got about 65 trillion worth of AUM when you sum them all together. So you need this advocacy and these partnerships to lift up and bring forward the focus on this ESG type investing. Within CalPERS, we do it both ways. We also individually within some of our asset classes think around how does this fit within an ESG framework. So from the bottom up, even down to, within fixed income investing around which bonds in terms of the risk versus the return. If you've got the same return but a different risk, given the different types of companies that you're investing in, which do you choose? So once again, this idea is the more aspects that you can come at this, keeping in mind that we have the return and we have to keep our risk, in focus. I think the more we move in the right direction on that front. Thank you, David.
Thank you, Lauren. Didier, do you have any points towards this, integrating ESG and also the question on nuclear?
Yes, on nuclear, you know that the French approach, and we really do believe in this approach, is to consider that the nuclear energy is much greener than Germany believe or did believe until recently. I mean, my point is that for sure it's greener than coal, etc., and should be considered as something that is, I would say, in line with our strategic goals, for 2050, the net zero emissions. And on the top of that, you have obviously, for obvious reasons, some strategic consideration following the war that we are seeing. I do believe that the gap, the historical gap, I would say that we had between German and French will disappear in the coming months. As I said, this is probably a paradigm shift. We saw that already, for Germany. We now, with the German government, will now respect the 2%, 2% of their budget, will affect 2% of their budget, to defense spending in line with the NATO objective. My point is that it's a U-turn, and we would expect some other U-turns coming from Germans looking ahead. You have to bear in mind, for instance, when you look at Germany, that you have many young MPs that will probably be more able to change their mind. And Germany today is far different from what it was, I would say, 10 to 15 years ago, when it comes to these strategic needs. So indeed, to answer your question, yes, indeed, it reinforces our view that the nuclear energy should be considered as a green energy. It will help us. You know that not strategic sovereignty, it's not only about defense, it's also about our dependence to oil, to coal, to many kind of metals, and it will not be enough, I would say, to reduce our oil dependence to finance the energy transition. So definitely, the nuclear energy should be considered seriously.
Thank you. Deputy Governor, do you have any thoughts to address the nuclear energy question, or would you rather us focus on a slightly different angle? But I have a secondary follow-up question for you as well. So
I think you should move to the secondary thought. It's
perfect.
Not my position as representative of anything about European energy policy. It will be what it is. I mean, on the personal, to be clear, we tend people tend to think that is risky and related. But my wife is French, so I know perfectly well. No, I we should rather take another question.
Perfect. My question is to all of you. How has COVID and the post-pandemic landscape, but also the shock that we saw very much play out as a supply shock outside of finance into an economic shock, and while it happened quickly, a lot of the same presentations, a lot of the same experiences that we felt will be shown in the climate crisis, and if we have a climate shock. So what lessons have you as investors, and how you manage your portfolios and view risk, how has COVID colored your thinking around how you tackle a potential climate crisis? So perhaps Oystein, we can start with you on what lessons are the key lessons that you've learned from the reaction to COVID, if anything, for when you look at your structure for the future.
Well, I think it has meant a lot. The crisis has made us much more aware of the awareness. Suddenly it was life and death and health of people. And I think, the trend was already there of rapidly increasing awareness on climate issues and other questions such as why. I think COVID made us more sensitive to this question. I'm saying this, so my view on the overall across the world, but I do think it's really important, and it's also for investors, because the big problem with climate change, so it happens so gradually that we're at risk of losing sight of the time horizon that is relevant for us as investors, and also in general, as I think that awareness has increased. I think that's good.
To follow up on that, and this is a question from the audience, what kind of institutional cultural changes are needed from your experience to develop and implement this responsible investment? So how far did it follows on from that conversation or that point you just made around how COVID really focused the mind? Has you seen a cultural shift, and what is the institutional changes needed? We had a session not that long ago that said that one of the main barriers to convincing the whole company to invest in green is actually to ensure that there is a cultural shift right from integrated right through for the whole investor. So at Norges Bank, how are you integrating that cultural shift?
Now, I'm happy you answered that. You asked this question because quite often actually, and I think the reason is because ESG, or responsible investing concerns, has been a bit of a silo, a separate unit, portfolio managers. So it was, my words, but it was almost like a side activity. And the IMs never operated in that way. So responsible investing and principles for ways have always been very high on the agenda. And I think in terms of management of the organization is integration. You need to make finance on one side, and then ESG on the other side. This fit together. You need to integrate that. And I think that is a key management for people that are leading investment organizations. You need to make sure that the relevant risks and horizons of us as ESG are actually taken into consideration every investment, and also in each and every dialogue, which means again that some incentive take really good care so that the companies are not only thinking about relative returns to the questions of ESG or responsible completely on the side. They are much more value of the portfolio and the longer term investment horizon. So you actually need, as a manager of an investment fund today, to have that.
Yeah, thank you very much. And Lauren, I want to ask the same question to you as CalPERS. You spoke earlier around the pandemic offering a regime shift potentially and what that looked like. So going into a little bit more detail, perhaps within how CalPERS have integrated the lessons learned from COVID into your portfolio management, and maybe a little bit about whether that shifts your the exposures that you have in different industries.
Thank you. Yeah, I would say it's still early days when I think about this. It's sort of hitting early to mid 2020 predominantly. Even prior to the pandemic, we identified that the US economy in particular looked like it was sort of in late cycle in terms of business cycle. And what does that mean for us? That means making sure that we have a resilient portfolio for any future downturn. Now, we certainly didn't forecast or predict the type of downturn we did see. But one thing we did find was that the resilience that we had built, in particular on the liquidity side of our portfolio, meant that, and also within our public equity exposure, meant that we outperformed to the downside in 2020, or our fiscal year 2020. So I think broadly speaking, when we think of it around these bigger questions, that's certainly one that held us in good stead, and that's something that we're constantly looking at, constantly looking to improve. Liquidity is something now with respect to what's happening in the global economy, and also with central banks tightening of monetary policy around what does that mean. Do we have the degree of liquidity that we would ideally like, and if not, where do we garner those sources of liquidity? So more generally speaking, speaking along those terms, more specific, of course, that would be more internal and remain internal here at CalPERS.
Thank you very much. Didier, the same sort of question to you, looking at Amundi. How has COVID changed your thinking with the assets that you manage? And also, how have you integrated ESG, if so, into your kind of the whole of Amundi? I know it's very important for you.
So for sure, we consider that the climate protection will remain the dominant issue for investment in the coming years. And interestingly, what we saw since the start, in fact, what we've seen since the start of the COVID crisis is a rising demand for ESG product from all investors. And we believe that it's only the start of this phenomenon. So regarding our portfolios, what we said is that companies, in fact, clearly companies that make special efforts in climate protection and the development of sustainable activities will be overweighted in our portfolios looking ahead. And that's clearly something that is very important, and I would say a key incentive. And in addition to that, open-ended funds that are the investment objective of net zero 2050, these funds will be offered in all asset classes. And I think it's a very important step that shows that our company, my company Amundi, is clearly wants to the cornerstone of the approach in Amundi is clearly to go in this direction, to finance the energy transition and to deal with these ESG products. So that's clearly the cornerstone of the investment approach.
Thank you very much. We have a question in from the audience around how do you see the recent discussions on big institutional investors restricting investment of companies in their portfolio to do fresh capex in high emission type energy production tools, and how this translate into energy supply security concerns? Do you see a pushback on this approach? So essentially, I think this goes back to some of the approaches that you mentioned earlier around the shift to from brown to green. Do you see that the future will shift back? What's the risk that there will be a pushback to the approach that is taking?
The question for?
So if we do Øystein first and then Didier, I'll come back to you.
Yes, so in terms of our investmental, this I think will be too much of to micromanage the companies that we invest in. Primarily through sort of from a top-down perspective, and we relate to the boards with these, expect them to tell us what they plan to do and to justify. I think that at least in our system, reaching too far into the decisions that should be doing.
Yeah, no, that makes sense. Didier, do you think that the idea of pushing high emission type energy production tools into transitioning rather than exclusion is the future, or do you think that there will be pushback towards this?
It's hard to say, but we see there are probably some conflicting objectives that we see these days between, on the one hand, increasing defense spending, on the other hand, financing the energy transition. My guess is that with a best-in-class approach, I mean, you can consider that many kind of investments can be in line, I would say, with our strategic objectives. But for sure, that's going to be a hot debate in the coming months. I would say, to reconcile different approaches in order to finance strategic needs. But as I said, I think for private investors, the key is clearly for Amundi to overweight, I would say, all the companies that finance, that have, that make special efforts to finance the development of sustainable activities. That would be, and probably with a best-in-class approach. So keep in mind that certain defense expenditures are not excluded from this environment. So that's a key issue, I think.
Thank you very much. We have, we're coming into sort of the end. Sorry, yes, yeah.
I could also add to this. I think it's currently there's very high finance community can do sort of in itself. I think that's perhaps the question here. To community go in and make the decisions in the companies and micro sort of the whole whole energy transition. For everything, and I think that is expecting way too much. The financial industry, the finance is important because it is but it's not. That's not the only part of the puzzle. We need to succeed with this energy transition. We surely need both from clients, from employees in these companies. They want to make the change. From the authorities, obviously, it would be much high cost of emissions globally. And when it's together, I think finance can play an important role. But I think it should. My personal view is that it should not go in and the companies.
Okay, thank you. No, that's very clear. Thank you for that answer. We're kind of coming up to the final 5-10 minutes before I hand over to David Marsh to close what has been two very detailed sessions looking at asset and risk management. We have a question here on the current ESG treatment of weapon financing and the current debate over weapon financing as a social asset. Does anyone want to take that? To have a little bit of color on the thinking behind this current debate. I think it's still very early days in this debate, but perhaps Didier, do you have any thoughts on that?
No, as I just said, I think an important point is that all the defense spending are not, I mean, can be considered as also some ESG products. But my point is that if you, I guess that also if we go in this direction, the ECB support will be crucial, I would say, to finance, because it won't be possible to do at the same time. I would say this was already a huge challenge before the crisis, and now we have a U-turn in terms of defense spending in Europe that will necessitate also several hundreds of billions of euros. So my point is that at this point, probably we will need to consider some other way to finance these strategic needs.
Austin, do you view that your criteria might start to view the weapon and defense spending within ESG? I know that we had a narrow focus in this debate talking around climate, so this is slightly more into the governance or the sustainability questions on a broader sense. Pardon?
We should not rule out that kind of change, I would say, structural change in the coming years.
Yeah, I think I will mirror Didier's last comment there, that without, you know, in the past number of European countries changing their policies in Ukraine, including my own country, which for the first time sent climate an active conflict zone. I will not speculate on how this will go, at least when that will need to have a broad, any changes in them on this issue would need to have you know, a uniform from all the political parties. This is not easy.
Yeah, no, very much take your point and agree there. Thank you for taking that question. I want to do a final roundup of all of you, so please answer this question and any final thoughts you have. My final question is, we'll start with Lauren. Please, could you view where you think, where you see the largest risk is in the future? So when you look at your kind of future planning, when you look at your risk management, where are you identifying the largest area of risk might come from? And obviously I won't hold you to this. There's no obligation, that there are many geopolitical factors that will be playing out, but where do you see, what keeps you up at night? Lauren, please.
That is a very large question. So, you know, put me on the spot. Yeah, I guess I put my economics hat on, given that's my background and experience. And I alluded to this a little bit before, and this is my personal view. Let me make quite clear, not necessarily CalPERS, but that is when we think around the future trends, so the secular trends in the global economy, it is easier to construct a future where real returns are lower than it is to construct a view where real returns are higher. Now, this is real, not nominal. And once again, this is my personal view. So within that context, attempting or, you know, being required to meet our set return targets, that becomes increasingly challenging. And so thinking around things such as an ESG lens, thinking around ways in which we can engineer those return targets in real rather than nominal. Of course, we pay out on a nominal, but thinking about those real returns is probably the one thing that keeps me up at night. You know, what are we missing? What can we include? CalPERS thinks about the entire investment universe. What ways in which can we ensure that we can pay our beneficiaries and our members going forward?
Thank you, Lauren, and thank you very much for joining us as well. Didier, over to you. What keeps you up at night? What do you think is the biggest risks that might face the investment landscape?
Well, in fact, if we fall in an outright stagflationary environment with a recession and a big inflationary pressure, for sure it is going to be a big shock, because at the end of the day, we would see at the same time rising debts, rising inflation, but also monetary policy, central banks, you know, in a corner with this kind of environment. We have not faced, in fact, that kind of environment since the late 70s, in a very, very different environment and we face these days huge challenges. So we see the stagflationary environment as something that could precipitate a kind of outright financial repression environment where central banks would lose their autonomy de facto, being forced to some extent to finance strategic needs, and at the same time, it could de-anchor inflation expectations and generate some second-round effects. That's probably the biggest risk. And against this backdrop, as I said earlier, we should no longer consider government bonds as a safe haven. I mean, my point is that you have probably within the equity space some liquid equities who could be, I would say, safer looking ahead. And I completely agree with what Lauren just said. My point is that as a real rate of return for asset prices is going to trend lower in this environment, because even if it's not an outright stagflationary environment, at the end of the day, we will face some stagflationary pressure with real interest rates in negative territory, with lower profits for companies, and that's something that is going to be quite challenging, I would say, for investors in the coming 2 years.
Thank you very much, Didier. And Deputy Governor Oistin, to you for your closing thoughts on what keeps you up at night in the context of investment and the largest risk that you think is on the horizon.
Yes, it's good you're precise in your question, because what keeps me up at night tends to be my 5-year-old comes creep. That keeps me up at night. But when it comes to the financing, and it's easy what both Lauren and Didier says here on the financial side, returns, inflation scenarios, etc. But one thing, it should be in the area of climate, or along so many dimensions, sustainability is just paramount in our century. Along so many dimensions, we are exploiting this planet, and this is related with the use of fossil fuels, and also along other dimensions. So I think if this be solved, then the finance plays its role in that. The risks are twofold, because there's obviously a risk its role, which is it must and should, but I think so quite a risk that finance a role for itself, which is bigger than what it can actually do. So I think that doing the right thing is and avoiding the greenwashing is also extremely for our sector.
I agree, and to follow on from that, and perhaps this is another discussion. The Sustainability Policy Institute at UNFIF looks at this as well, and is going to continue in more detail, but look at the unintended consequences of perhaps climate climate products onto the biodiversity question. So how those two things link in, and I think the continuing questions of biodiversity protection it has to be played into these discussions as well. So there's a lot more unpacking and a lot more thought to be done, but thank you very much for joining us and giving a little bit of flavor onto how we integrate ESG into investment frameworks. But also, Lauren, thank you for discussing how CalPERS is looking at risk and also giving that macro environment. Thank you, Didier, for bringing us into Europe and the great financing need, both with the security challenges that the geopolitical environment is placing on us, but also the green and climate need. And then Oistin for giving us such a good overview of how you exclude and include the ESG into your 9,000 companies that are in your portfolio. So thank you all for joining us. David Marsh, I want to hand over to you. This is the asset and risk management series that UNFIF plays out throughout the year. We are very pleased to have the support of Amundi in it, and also all the speakers that over the years have joined us. Hopefully we will be doing it in person once again. I have fond memories of doing these over the years in person, as I'm sure you do, David. David, and I think all of you as well has joined at some point in person. So David, and thank you to the speakers. So over to you, David.
Yeah, thank you, Eddie. Yes, well, my praise particularly for Lauren for getting up so early, but having some cups of coffee to keep it going, and Øystein also for telling us both about your French wife and your 5-year-old son. So we're certainly piecing away the veneer of the Norges Bank. That's very good. But I felt that we did cover a lot of ground. As Neil Williams said, it was a game of two halves. We concentrated in the first half more on the macro questions, and given the devastating influence of what's going on in Ukraine, I think that was very right. A lot of this, of course, we're still in the area of looking at tea leaves. We don't know how that's going to pan out. There's a lot of scenarios in Ukraine, many of them pretty dire, I have to say, regarding a long-term settlement with whatever emerges from Putin's Russia. So we spent quite a bit of time on that. And in the second half, we delved much more deeply into the whole question of risk management, and particularly into the area of ESG. And because we are looking through a glass darkly, I don't want to come to any real conclusions here. There were three big issues, I think, that we discussed, and I'd like to give an equivocal answer of yes and no to each of them. So in the first big question, which is really how a central bank's going to react to the changed environment over the last 18 months, because we've had the inflation with us really for that amount of time. It's just become very much direct in the last few weeks. I think it's going to be yes and no. We're going to be seeing the Fed probably ploughing on with a fair degree of tightness, and the ECB will be much more equivocal and will be prevaricating much more. And this is because Europe is at the center of the storm. I thought it was very good that we had Julius from the NBP, the Polski Bank, earlier on talking about things in a very reasonable, straightforward, down-to-earth way. But Poland is really at the front line at the moment and is taking in the majority of refugees, and that's been affected, or that's affecting also the exchange rate. So we had a very reasonable, calm conversation with Julius Jauer as well from the Banca d'Italia, Carlos, further away from the Philippines. But it does strike me that the ECB of all these different central banks is in the worst position because Europe is being affected by the inflationary surge, not least because of energy and the need to find new sources of energy in a quick way. And the ECB is going to find it very difficult to do anything that's correct at the forthcoming meeting on Thursday. So a yes and no response there. I think, Didier, you were quite right in saying that the danger of financial repression is getting larger, and we could be back to a situation not unlike the one we had during the Second World War, which didn't end until 1951, when, for all sorts of overarching reasons, the Central Bank of the United States was being asked to keep interest rates very low. I think we could easily get back into such a situation when it comes to the ECB. I think with the Fed, there's also a risk, and it depends who wins the next presidential election. So I'll say no more about that, but that is a big risk, I think, for everybody. Second point is the whole question of risk management and where are we? Is there a paradigm shift now following the war in Ukraine? This is the first hot war in Europe, after all, the first really big hot war since 1945. We've had the Cold War. We had maybe a phony peace over the last 30 years, but this is now for real. And the very fact that we spent so much time in the first session talking about gold is a proxy, I think, for the fact that people are thinking much more now about risk, also the physical risk of where you keep your assets. The Central Bank of Russia has learned that lesson too, but I'm sure the Russians do have some way of getting around that. We didn't go into that very much, but gold is a proxy, I think, for speaking about those issues. And the very fact that the Polish central bank has been building up its gold reserves, the Italians have had the gold there for some time, since the 1950s, as Joya said, a legacy issue. That does show that gold is not going to go away, but there's other assets too. And I was struck by what you said, Lauren, just now about what keeps you awake at night is whether you've missed something in terms of finding returns for your investors and for your shareholders and for your pensioners. So that we will still be on a multi-year journey, I think, to find out what these best investors are. Has there been a paradigm shift? Well, yes and no. I think it's silly to say that everything has changed just over the last 2 weeks, but on the other hand, it sharpened changes that were taking place already in our minds. So to the extent that I can say both yes and no, we have had a paradigm shift. The third point is on the whole question of ESG and whether one should delineate this in a separate way. As you said, Lauren, if you follow the right risk and standardization and return types of approaches and look at these things in a very mechanistic and very well organized way, then you'll probably find, as you said, that most of your investments do fit into the ESG bucket. But not everybody's got the fortune to be able to afford a good body of staff that will actually tell you whether you're following these principles or not. A lot of these people do it on the basis of recommendations or because they're being given a list. Some private sector company has come up with some form of principles which certain companies fit into. So again, yes and no. I can see the Anne Simpson point that we should make all this holistic. We shouldn't have any boundaries. On the other hand, I can see the virtue of having specific funds in the way that the biggest sovereign fund in the world has it, with the NBIM. And yes, I can certainly see in the case of Didier and Amundi, the great virtue of making a marketing speciality out of ESG is that you do get a lot of publicity for what you're doing, and you get a lot of talented people working for you, and you get a lot of funds under your belt. The one thing that I was struck by actually is that everybody thinks that equities are the area to be investing in. That goes for the central banks as well as the private sector. And I think we're not going to get rid of the need for an ESG label for a lot of these equities. That's going to apply to a lot of what both the public sector and the private sector stands for. Over time, perhaps all this would be migrated into one large bucket, but we're not there yet. And this is much more than a marketing issue. This is a big political question. I was struck by your boldness, Didier. This was maybe the quote of the conference, that you felt that the gap between the French and the Germans, which is historical, but certainly it's historical since Chernobyl, regarding nuclear investment, that you foresaw that gap could narrow or even close completely within the next few months. I support you in wishing that will happen. I doubt whether it will, but I'm very happy to do something with you together, as we've been saying, chatting here, to help bring that about, because I think that would be very salutary. The Germans, after all, did actually discover nuclear fission in 1938. So it's been somewhat ironic because of history that they've turned away from it, particularly since the 1980s. So there were a lot of issues here, and it's impossible to sum it all up. Like Ellie, I very much hope that we will get together in a physical sense before too long to discuss all these questions, where we can then meet for lunch. We should be going to lunch together now rather than going off to our individual pursuits. But I'd like to add my thanks to what Ellie has said and Neil earlier on. Thank you very much indeed for taking part in this, the speakers and the audience and all the people behind the scenes who've done all the logistics to make all these schemes of technology work properly. And let's take these views that we've gained and the different influences and opinions that we have shared and take them with us in the next 12 months and try to build out of this a better investment landscape and, may I say it, a better world. So thank you all very much indeed for taking part, and we look forward to the next stage when we can be together in either a technologically enabled virtual environment or, I hope, a lunch-fueled physical environment. Thank you all very much, and I'll bid you all good day.